the event organized by Anglo-American University in cooperation with IREF, this l'Institut de Recherche Économique et Fiscal, located in Paris, which will be represented by Agnieszka Słomka-Gołębiowska, and in cooperation with the Liberální Institut, in cooperation with Natland, represented by Petr Bartoň, and in cooperation with Wonderinterest, represented by Olivia Lacenová. We have keynote speaker, Professor Jan Schnellenbach from the Brandenburger University, located in Cottbus, Brandenburger University of Technology. Our topic is fiscal reform in European Union, the discussion about the rules of fiscal policy and potential change of these rules, and it's really topic for us because with the new just tax rules in the Czech Republic that were presented this week, last week, yeah, so time is so speedy. So it's a topic. We have also just media company that will present our debate in Czech media list. So thank you very much. And the discussion leader will. So I am so sorry. So that, but you could hear me, but we should use the microphone. Okay. Agnieszka, the floor is yours.
Thank you very much. I hope you can hear me. So I have this great pleasure to welcome you to the, I think, another meeting of IREF conference. And we are very pleased to organize it in such a beautiful place with such a great company. And as it was said before, today we have a guest from Germany who will present a topic on reform of fiscal rules in Europe. As we have heard, your field research is economic policy, economic behavior, as well as analysis of economic policy. So we are very pleased to be here, and I will give you a floor, and then we will move to the discussion. So the rule is that we will have 30 minutes of presentation and 10 minutes of discussion from each of us. Thank you so much, and let's give the floor to the main guest. Would you like me to give you the mic? Because I think you need a mic.
I'm just trying to find my... Okay, so there we are. So thank you for the very kind invitation here to Prague and to this beautiful place here. What I'd like to talk about today is the reform of fiscal rules in Europe and the question where we stand at the moment. And I'd like to make the following points. Let's go this way. Okay, the following points. After a short introduction about what this whole thing is about, I'd like to talk about briefly why we need fiscal rules in Europe at all, and then about the performance of fiscal rules in the past. And then the biggest part of the presentation will actually be about the reform proposals in the current debate and the question if we can expect that they will actually work, these proposals. So what we've seen at the moment is a discussion about a reform of fiscal rules based on reform proposals that have been put forward by the European Commission, first in November 2022, last year. And these reform proposals got some positive feedback on the one side from the countries with higher debt levels and rather negative feedback from the countries with lower debt levels, from the fiscally frugal countries. And the general perception was that these reform proposals gave even more discretionary power to the European Commission than it already has in deciding what to do with high indebted countries. And after this criticism, the Commission put forward a revised reform proposal in April, beginning of May, about 2 weeks ago. This is currently discussed and it's currently negotiated about in the ECOFIN Council of Economics and Finance Ministers. And the problem, of course, is relatively pressing because at the moment the rules are suspended on the European level due to the COVID crisis and the energy crisis. And we all hope that there won't be another crisis which gives the Commission reason to suspend fiscal rules even further for another year or two, but we never know what happens. But the problem is that it is also unlikely that the Commission will enforce the status quo set of rules very forcefully, because it hasn't done it in the past, and there are reasons in the rules to assume that it becomes politically infeasible to enforce them as they are. So we expect that the old set of rules won't be enforced. So basically all countries have an interest in some kind of reform of fiscal rules. Some want more lenient fiscal rules, some want more strict fiscal rules, and some compromise will need to be found between them. So, why do we need fiscal rules at all in the EU? There's some basic answers to this question, and these answers evolve around policy externalities. The basic problem is that when you have a monetary union and you have independent fiscal policy, then all kinds of policy externalities follow from independent policy making. These can be of a fiscal type, for example, spillovers of risk premia from high to low debt countries. That can be a problem, that there are implicit bailout expectations, and due to these implicit bailout expectations, the risk of low debt countries is also priced higher. That might be some kind of a policy spillover. And there might also be policy spillovers from fiscal to monetary policy. We call this fiscal dominance when monetary debt financing occurs and when the independent central bank hesitates to impose a strict monetary policy, even if it was necessary, due to concerns that highly indebted countries might run into trouble due to higher interest rates. So this kind of fiscal dominance is also a problem. And of course, we have seen this with the whatever it takes speech by Mario Draghi 11 years ago now, that the ECB is willing to actually save highly indebted countries. The problem is also that the entire set of monetary and fiscal institutions relies in its credibility on keeping low debt levels. When debt levels rise in some countries, these rules, these institutions will be tested. And it's very likely that these tests end negatively for these rules, that these rules are broken, reinterpreted, renegotiated in some way that leads to higher debt levels. So it's important to have reliably working fiscal rules that keep debt levels relatively low from the beginning to avoid these rules being tested at all. And we have, of course, national level incentives. We all know this from political economy, things like fiscal common pool problems in cabinets. We have fiscal illusions when voters underprice public goods because they are debt financed and demand too many public goods. All these kind of things can happen and are amplified in monetary unions. So the problem, the incentives to run debt finance that we have on the national level, that we always have on the national level, these problems, these incentives are amplified in monetary unions and need control through appropriate institutions, through appropriate fiscal rules. So there's definitely a reason that we need fiscal rules, and the question is how these rules actually worked in the past. And if you look at the past, then we see, well, a recurring pattern in the application of fiscal rules in the European Union. And the recurring pattern is that the European Commission always had quite wide discretionary power in applying these rules. This discretionary power of the European Commission resulted from the fact that there were no automatic corrections, no automatic sanctions, and also always a few more or less explicit escape clauses with room for interpretation that could be applied to not sanction a country and not force a country into correcting its fiscal policy. And this discretionary leeway of the European Commission has always been used, or almost always been used, in a way to avoid open conflict with member countries, to appease countries that have high debt levels, and not to enforce low debt levels on these countries. There's always been an incentive working for the European Commission to avoid this open conflict, with only one real exception, and that was at the beginning in 2004, and we'll talk about that in a moment. So if you look at this pattern of being lenient and using this discretionary power in a way not to strictly apply rules, it started right at the beginning. If you look at the discussions about admittance to the European Monetary Union back in the 1990s, the Maastricht criteria, you all know them probably, stipulated that countries with deficits below 3% of GDP and debt levels below 60% of GDP should be admitted to the European Monetary Union. And there was this escape clause already back then that needed interpretation, that also countries with a trend from above at a satisfactory pace towards these thresholds could also be admitted to the European Monetary Union. And for political reasons, the Commission wanted Belgium in. It was politically completely infeasible that the country in the heart of the European Union, where the capital of the European Union is, Brussels, that this country would not be part of the European Monetary Union. It was unthinkable politically, so they wanted Belgium in. And Belgium had a debt to GDP ratio of 130% back then, clearly above 60%. So it missed this numerical target, but the Commission interpreted it in a way that Belgium was on a satisfactory pace towards the threshold value. But when it did that, then it had no further numerical or political arguments to exclude Greece, which had just about over 120% at this time. So you have this domino effect in a sense that once you are lenient and once you make compromises in these fiscal rules for political reasons, it's difficult to enforce them on anybody else. And this really turned out to be a pattern, a recurring pattern in Commission policy to avoid conflict, to be lenient in the interpretation of these rules. One exception in 2004, the Commission attempted to impose corrections and even sanctions on Germany and France back then. Even Germany broke the rules, the deficit rule back then under the Schröder government. But it needed a majority in the council to do so. And the council, obviously politicians don't really enforce rules upon each other. The council didn't provide the majority for sanctions and for rule enforcement. The Commission tried to win a case before the European Court of Justice about that. It even did win the case for formal reasons. But that was the only incident where it really strictly tried to apply the rules, and after that we saw basically only a very lenient approach by the Commission. After that, before the monetary union actually coming into place, the Stability and Growth Pact came into being in 1997 as the set of fiscal rules for the monetary union once it came into existence. And again, we had this seemingly strict numerical rules on the one hand, the Maastricht criteria I've just been talking about. We had, on the other hand, however, things that need to be interpreted. For example, a reference to special circumstances that could be used to excuse non-rule compliance. And special circumstances is something that of course you can interpret, and that the Commission did interpret in a very lenient way. Nevertheless, the Stability and Growth Pact demanded that countries plan their budgets close to balance or in surplus in the medium term, which is quite strict. And it also had a corrective arm, an excessive deficit procedure with close monitoring and a threat of sanctions to non-compliant countries. But again, sanctions and enforced corrections were never be imposed. In 2005, after even countries like Germany missed the deficit criterion, the first reform of the Stability and Growth Pact was enacted, and it made the rules even more open to interpretation. It opened even more discretionary interpretative power for the European Commission, so it was essentially a weakening of the rules. And we saw essentially, I'll keep this brief, we saw essentially that countries ran higher and higher deficits and debt levels after this reform in 2005. Again, the Commission used its discretionary power in favor of countries with too high debt and deficit levels. It even abrogated an excessive deficit procedure against Greece in 2007, even though Greece clearly was above the numerical levels. So there was no rule enforcement back then. And we all know what happened next. We had the global financial crisis, we had the European debt crisis, we had basically the end of the no bailout clause in 2010, when we had highly indebted countries and when the EFSF was founded in order to bail out these highly indebted countries that had lost access to financial markets, that could not refinance themselves on financial markets themselves anymore, or were close to losing access. And in 2011, the European Stability Mechanism as a permanent facility was invented with a lending capacity of 500 billion euros as a permanent mechanism to provide security to countries that ran too high debt levels and that were in danger of losing access to financial markets. And then in 2012, the whatever it takes speech by Mario Draghi followed the willingness to also buy government bonds by member countries on the secondary market. And when you buy government bonds on the secondary market, there's arbitrage and financing conditions generally improve for these countries. So even monetary policy was willing to bail out highly indebted countries. And that led to a period of relative calm on the financial markets. The interest rate spreads of highly indebted countries declined, but that also meant that market discipline didn't work anymore. The market didn't enforce discipline on highly indebted countries because interest rates were basically reduced for these countries by this announcement to do whatever it takes by Mario Draghi. So, what happened next? we needed, because market discipline was gone, we needed more fiscal rules, the so-called 2-pack, 6-pack, fiscal compact, a quick follow-up of different sets of formal fiscal rules that were intended to provide more discipline in the next years, but it didn't. Again, to keep it brief, what we've seen in the years here was essentially that the highly indebted countries continued to run high deficits, and even if they didn't run high deficits, they at least failed to reduce their high debt to GDP ratios. So if you look at what happened next, then at the beginning of the COVID crisis, or before the beginning of the COVID crisis, if you look at this point in time and keep the most recent crisis even out of the perspective, then we see that countries like Greece, like Italy, really didn't reduce their debt to GDP ratios, and that meant that they were highly, highly vulnerable when they entered the COVID crisis and the energy crisis. They already had high debt to GDP ratios, very vulnerable, and what then happened actually was that we for the first time saw a common European debt instrument, because again, we needed some bailout mechanism for these highly indebted countries. They needed to be provided with additional funds, were in danger of losing access to capital markets themselves, and so we had common European debt for the first time. So if you briefly look at all of this, I think it's quite obvious that these rules need to be reformed. In all these years of monetary union, they didn't work to restrict deficits, they didn't work to restrict excessive debt levels. So there needs to be some reform, and it's useful to look at the reform proposals that are actually made. And if you look at the reform proposals from academia in a first step, not the reform proposals by the European Commission, but the reform proposals out of academia, then you can basically group them into two groups. The first are the fiscal dafts, and the second are the fiscal hawks. And what the fiscal dafts in academia are proposing is, first of all, a suspension of the 1/20th rule. The 1/20th rule demands that countries with debt levels above 60% of GDP must reduce 1/20th of their excessive debt in each year. If you look at Italy, for example, with now debt to GDP ratios around 180, 190%, that would mean that they would need to reduce their debt at incredibly high levels each year, and that's completely infeasible politically. So there's this proposal to suspend this 1/20th rule simply because it cannot be enforced reasonably. There's the proposal that we should increase the acceptable debt to GDP ratio to 100% from 60%. The argument is that with still low interest rates, higher debt levels are sustainable. But that's, of course, a somewhat problematic argument, because we're just seeing interest rates rising, and they might keep rising for a while. So it really leads to a bit of a more risk exposure if we allow for 100% as the regular normal debt to GDP ratio. There's the proposal to distinguish between normal excessive debt and crisis or investment-related excessive debt. There's always this argument that fiscal rules prevent countries from investment, from investment spending, and so there's this proposal to exclude investment spending from debt enforcement and give countries an incentive to invest more. When spending rules are proposed, spending rules are used to directly steer countries by giving them upper limits for the annual spending they are allowed to take. And if a spending rule is applied, then Also, the proposal is there to exempt investment-related spending from these spending rule calculations. And there's also the proposal to stop using structural measures because it's notoriously difficult to correct for business cycle influences in calculating what the full employment level of GDP would be. That's very difficult and mistakes can be made there. So the argument is there that we should stop using structural measures and stick to directly empirically observable measures. And if you look at the fiscal hawks, then the proposals are different in most instances. The fiscal hawks, however, also agree that we should suspend the 1/20th rule, again, due to political infeasibility. The fiscal hawks also propose that we should have lighter sanctions because with lighter sanctions, the likelihood of applying them is higher. The argument is simply that right now the sanctions that are available are too harsh, so that the Commission will never apply them, and that with lighter sanctions, the likelihood of applying them would be greater. A very important point is that the fiscal hawks demand automatisms, automatic triggers for corrections and sanctions, less discretion for the European Commission, more automatic responses to violations of numerical rules. There's also the proposal to have an independent, non-political body evaluate if excessive deficits can be justified by special circumstances. At the moment, we're seeing the European Commission use this escape rule to justify high deficits and high debt levels, and it would be actually reasonable to have, instead of the politicized European Commission, an independent expert body and make this judgment. And also, the fiscal hawks propose to use expenditure rules, directly steer expenditure of member countries rather than making them steering their deficit paths. But they propose to use these expenditure rules in addition to medium-term structural balance rules, in addition to demand structural balanced budgets in the medium term, and not instead of doing this. So these are the two sides of the continuum, basically, of the academic debate. And if you look at the European Commission's position in this debate, then the overarching rhetoric in the EC's proposals has been that sustainable debt levels are one important, but only one policy goals for them. The discussion is embedded in a broader set of goals, including also promoting sustainable and inclusive growth and things like that. The Commission also emphasizes that structural reforms and investment commitments by member countries should be taken into consideration, that countries that undertake structural reforms, that do something for growth, that invest a lot, should have a bit more fiscal leeway. They also a core part of the EC's position is that net expenditure limits should be used actually as the central control variable. That the Commission directly makes proposals on the maximum expenditure that countries might run. And the focus there is net expenditure. That's expenditure without interest payments and without expenditures beyond the control of governments. So, for example, when you have a budget cycle slump and unemployment rises, then spending on increased unemployment would be excluded from these spending calculations. So it's also, again, something that's up to interpretation, what is actually beyond the control of governments. Nevertheless, the Maastricht criteria remain important numerical anchors in this new proposal. How this thing works in detail? Well, briefly, I guess I have 5 to 10 minutes. Okay, quite briefly. In detail, it works like that. The European Commission, first of all, decides on a so-called technical trajectory. a technical trajectory for the expenditure of a country, and this technical trajectory should be making sure that the debt to GDP ratio of the country declines over a 4-year planning period. But it does not need to decline in every single year. The adjustment must not be backloaded, so it's not legal to do all the adjustment at the end of the planning period. It must be credible to start adjusting also at the beginning. On average, expenditure growth should also remain below medium-term GDP growth in order to ensure that debt to GDP levels are declining. So that's the technical trajectory, and that's sort of the benchmark in the process. And then the European Commission negotiates so-called medium-term fiscal structural plans with each member country. And in this medium-term fiscal structural plans for at least 4 years, and under some circumstances, like difficult structural reforms, this period can be extended to 7 years. The country lays out what it intends to do, how it wants to meet the numerical criteria, the Maastricht criteria during this adjustment period. And these medium-term fiscal structural plans contain net expenditure paths. And these net expenditure paths are proposed by the country itself or negotiated with the Commission. And then these plans should also address other policy goals of the European Union, like the European Green Deal, the European Pillar of Social Rights, the digital decade, and all these kind of things. So all this should be taken into account in negotiating these net expenditure paths in these fiscal structural plans. And then this is negotiated with the European Commission. The European Commission verifies the plan submitted, checks if all these criteria here are met, if we have a reduction of debt over the entire period, if the 3% criterion is met, if there's a proportionality of the adjustment effort over the whole adjustment period, also, if the 3% criterion, if everything remains unchanged, also met for 10 years after the end of the adjustment period. And if the Commission endorses the plan, it's forwarded to the Council, and if the Council also endorses it, then that's the plan for the next 4 to 7 years for the country. If the Council does not endorse it, or if the Commission does not endorse the fiscal structural plan, then a revised plan can be submitted, again, negotiation processes between the countries and the Commission. And if then also, again, no satisfactory plan is submitted, then the original technical trajectory proposed by the Commission is the fallback option. Then that's where we are back at. So basically, the technical trajectory is a benchmark for negotiations between the Commission and the member countries. And to this one, we fall back if there's no result in the negotiations between these two parties. And then there's an implementation phase with lots of reporting, monitoring by the Commission, and the Commission can issue a warning if there's a risk that the next net expenditure path or the 3% limit will be exceeded, which means that even if the original expenditure path is followed, but this original expenditure path turns out to be incompatible with the 3% deficit limit, then a warning can also be issued, and revisions should and can be made. But again, there's plenty of escape clauses like severe economic conditions, like economic downturns in member countries, exceptional circumstances beyond government control. Again, escape clauses with a lot of interpretative room. And then there's the excessive deficit procedure, and that's triggered if either the 3% deficit is breached or the 60% limit is breached, and the net expenditure path is violated. So that's an and, not an or. Both must be the case for the excessive deficit procedure to be initiated, or if in a debt sustainability analysis a country is shown to face substantial debt challenges, substantial risks. So that's the three possible triggers of an excessive deficit procedure. And the EDP also, again, does not lead to automatic corrections or automatic sanctions, but it leads to renegotiations between the Commission and the member countries. And again, all this here needs to be taken into account. The implementation of reforms, investments, in particular policies to prevent and correct macroeconomic imbalances, and next generation EU and all those nice Commission programs with lots of spending requirements also need to be taken into account. Again, there are corrections in the excessive deficit procedure, renegotiations, and eventually sanctions can be applied up to 0.05% of GDP. So that's a tenth of sanctions, of the upper limit for sanctions we have now. But 0.05% for each 6-month period. So if a country remains non-compliant for 6 months, the next 0.05% would be imposed as sanctions. So we have lighter sanctions. In that sense, sanctions become more credible, but still they come after a very, very lengthy process of negotiations or renegotiations, and it's very unlikely that they will actually ever appear. So will it work? Unlikely. There's a requirement to set technical trajectories consistent with declining debt is triggered automatically with these numerical Maastricht criteria. So that's a pro. But on the other hand, negotiation of fiscal structural plans is open to many, many discretionary interpretations and judgments. And it's, given the track record of the Commission, the avoidance of conflict with member countries, it's very unlikely that the Commission will be very strict in these negotiations over fiscal structural plans. And it will probably not be strict vis-à-vis a country with substantial political clout. A simple and transparent expenditure rule would work to map debt ratios into corrective policy requirements and do that automatically. For example, demand a minimum difference between GDP growth and expenditure growth, depending on the excessive debt level. And the EC proposal does this only on average and only for the technical trajectory, but not for the net expenditure path. And that's hidden in the fine print, really, that this is only applied to the technical trajectory and not to the net expenditure path. So again, a possibility to move around strict application of these rules. And another point is that we would need a common safeguard that would guarantee that debt reduction occurs even if the net expenditure path by itself does not achieve this in the implementation phase. So if the net expenditure path fails to lead to debt reduction, then another rule would be necessary as a safeguard. For example, a rule that maps debt to GDP ratios to minimum standards for annual debt reduction. But again, we don't have that. We only have this warning requirement, and the warning leads to renegotiations. And also that goal that debt to the GDP levels need to be lower at the end of the adjustment period, that goal is completely unambitious. It would be met with any small epsilon greater zero. So that's not really an ambitious clause. It will probably not work. And then there are a number of further problems to sum up as the final argument. We know again that the Commission does not act if it is only concerned with fiscal sustainability, and without automatic corrections, it will use these escape clauses that are there. It will use its discretionary power to avoid conflict, and this problem is not solved. There are no automatisms in these new proposals. In particular, it's likely that some pork barreling trading off fiscal sustainability to other policy issues will occur, especially with countries that have some political importance. If you think about France, for example, then it's likely that it will use its power on other issues to also get a lenient response to violations of fiscal rules. Time matters. All these interpretative leeways lead to the possibility to delay the day of reckoning, to keep kicking the can down the road until the next elections and then the next elections. So you can push this back quite far, and for an incumbent government, it's of course there's a large incentive to use this. If the Commission is willing to play this game. And finally, there's this argument that this negotiation between the Commission and member countries leads to more ownership for fiscal rules, that the net expenditure path is perceived as sort of a rule that a country gives to itself and adheres to on its own terms. But given the negotiation process, that's very doubtful that this works out. If a country does not comply with the rules, it can still very well use the Commission as a scapegoat in national politics. So that probably also won't work out, this ownership argument. So from a fiscally conservative perspective, that sums it up pretty much, that we have a rather disappointing set of reform proposals so far from the Commission, and we can only hope that the fiscally frugal countries, not only Germany, but also, for example, the Nordic countries, will be strong enough to enforce some more automatic corrections and automatic sanctions to make this more plausible. Okay, thank you, and I'm looking forward to the discussion.
Thank you very much. Thank you very much for this very interesting presentation. This one doesn't work. Okay. So, as we discussed, the aim of the paper is to investigate the path towards the current situation and reform proposals in order to improve fiscal governance in the EU. You didn't want to see the main. You didn't want to hear the main speaker. You want to hear me. Good. So the aim of the paper, as it is presented right here, is to discuss the path towards the current situation and reform proposals in order to improve fiscal governance in EU. The motivation is sound, and it was clearly presented. On one hand, we have several highly indebted countries that have strong interest in watering down the system fiscal governance in EU, and the interest is increased through many recent crises, and those kind of instruments could help them to run as going forward. Then in an opposition, we have a number of fiscal frugal countries with interest to avoid the introduction of common debt mechanism, so financing one country by the other in the form of debt, and a secure fiscal sustainability in the European Union. The context of analysis is given, and the author briefly discussed the political and complexity, not just within Europe, but also probably we should look at wider, also not just Europe, but globally. It's not easy. And if we look at the indebtedness, actually Europe is not as bad. We have Japan that it's out of the room, right? If we think about, or Switzerland, notably in recent weeks, right, bought a country with within 1 week without any due diligence. So why to complain about European Union? Yeah, like countries that's supposed to be much more restrictive, doing things like that. And then we have economic-wide also very complicated situation and increased inflation, rise of interest rate, high world record indebtedness after COVID. But also at the same time, which is scary, we have falling investment rates as never before. Yeah? So that should be talking together, and I was a little disappointed that we didn't tackle that one. Yeah, because investment is a growth. So if we want to look at that, I would think is necessary. But then it's something that was mentioned, but I think it is worth to underline. It's the polycrisis. It's a term from, I think, 70s or 60s, but has been recently recoined, if I could say so, when we have this interplay between COVID pandemic, the war in Ukraine, the energy crisis, the food crisis, all comes together. And when research shows this disparate crisis interacts in such a way that the overall impact could be much bigger than if we have a single impact. Yeah, so this all is unfortunately very much connected also to this new law proposal. So as we say, and it was, so I just briefly reconfirmed the main findings that it might not work because it's not clear, always a little bit ambiguous in a way it should be put forward. The worry is that it may prolong political equilibrium with high debt because of this bargaining and related high transaction cost to that. There was statements about sanctions. They are more credible right now due to the lower amount. However, the probability of them to be implemented are lower due to the lack of political will, and also the fact that winning political conflict over fiscal prudence against Germany or France, which was surprising because France is actually heavily indebted. Yeah, when I compare to Poland, I mean we are like a role model. So when we look at France, yeah, and also Czech Republic, so this is. On purpose, I bring the example of France because later I would like to refer to this example. What questions we could raise? So given this polycrisis and the complexities, I would be tempted to define a little bit more what is the fiscal sustainability in the paper. Yeah? Because the complexity right now that we are facing might be important for understanding this term. And then when I think about this interconnectedness and also sustainability, I think on the other side of the coin, and I think where all these Italian debts are being gathered in the German banks, right? And they are long-term. So this is not just European Union that is weakening this game, but there are also financial stability on the other side. So this game is not as simple. That's why, on the other hand, if we take into consideration the highly indebtedness context, and as I said, Europe doesn't look as bad as some other developed countries, then this assumptions seems to me the rationale of that the high indebtedness is only driven by the implicit optimism that interest rate will be always low. I think there is more arbitrage, there is more opportunistic behavior there than that just simple optimism. Then I look at the analysis of the current EU proposal, and as it was mentioned, that most of the shortcomings of this proposal comes from the analysis of a German Minister of Finance. And I was thinking it would be very interesting to also add some additional angles to those analysis of the policy making. Very interesting case about sanction. My background is I'm an institutional economist. So rules to be enforced, they need to have sanctions. This is what I agree. The thing is what kind of sanction works, yeah? And I'm not sure that in this setting, monetary sanctions, even the small one, are credible, because politicians are guys without money, yeah? So they get from one pocket to another, so monetary sanctions are not for them. I would rather think, if I could, I would rather encourage European Union to think about sanctions that would be painful, and for politicians are painful to be out of the game. So maybe something, you know, if you don't comply, you are not anymore as important player within the group, within the club. So that would be my kind of understanding. But I agree with you, and especially with the smaller sanctions, when it comes to players that only cares about power, not money, then it's like you drive Porsche and you have already on your card money for the ticket, yeah? So that's kind of, if you give monetary sanctions to these players, might not be as effective. And there was also a point about the risk of further politicizing the process because of the bargaining, yeah? So that's obviously, first of all, it's very costly, and it's not just pure monetary cost, but it's also transaction cost and weakening different institutions and the rules of the game. But what I found interesting and different is that there is, and I saw someone who will be speaking and who is an expert in a game theory, right? So there is so I hope he will support my argument, but I think what is interesting at the first time we can see in a policy making, it's the end to the game, yeah? So at some point, the Commission comes back and there is the program that they invented. And I'm from Poland, and actually I'm within this game because Poland was giving the Swiss franc credit, and right now people, because the Swiss franc is so high, people decided that they will sue banks, yeah? And it's been a very frequent phenomena, and we don't have a law on that. Hungary introduced a law, Poland didn't, and this is a private lawsuits. And it's like 19 billion of PLN, which is huge money for the sector. And they went to the court of EU, and this is the end of the game, because you go to EU only when you cannot solve your issues at home. Yeah? So EU will always take the side of small guys. So I think if they come back to EU, then it will be exactly. So this is something that, you know, teach the rule of the games of those one who want to be out of the rules. And the last thing, which I also find different than so far, and maybe it's an interesting thing, is what you mentioned, Jan, is this putting more independence. So like a central bank, someone who would be independent from Commission. And this is we know that from financial system or other institutional system, that could decrease significantly the transaction cost. So very interesting analysis, very insightful. Thank you for all the journey, because it was very informative, and I would like to give the floor to another discussant. Olivia, it's your turn. Thank you so much. Would you like?
Okay, thank you very much for your help. So, ladies and gentlemen, my topic is debt crisis and investor behavior. Let me introduce our company. And I hope it's working. This way? No? Okay. So, here? Perfect. So, Wonderinterest Trading Ltd is a Cypriot investment company securities and registered by Cyprus Security and Exchange Commission. We provide investment financial services in a member EU states, and our clients can choose from physical shares and also popular CFD products. That means contract for difference, which is also allowed the use of leverage. Our goals. Among the features, there is a product trained responsibly and a so-called metaverse index. The former focus, our clients, is clients' attention on companies that build their business on the strong ESG indicators. That means performance allowed by responsible environmental, social, and corporate governance approach. The latter, the Metaverse Index, which is a new phenomenon on a digital era, includes 8 major players in the field. We track their performance in the capital markets on daily basis and focus on them to analyze companies and also market trends for our clients. Of course, our clients are traders, people who sell or buy various assets on the financial and capital markets, many of them on daily basis. They include not only specialized professionals, but also retail customers. Do you know what is the 4 nightmare for every trader? It's a war, climate collapse, fiscal imbalance, and financial crisis. Each of these possibilities is a reason for high volatility, unexpected moves, and prevailing negative sentiment in the markets, and results in a fall in the value of several economic segments. On the other hand, negative sentiment in the global capital markets is a good news for gold, which is a safe haven for traders in the turbulent times. Fiscal crisis is the inability of a state to bridge the gap between its spending and revenues. It is one of the main factors behind the negative sentiment and or volatility in the financial markets. Fiscal deficit usually means in a financial and economic crisis, if the level of sovereign debt contributes to a loss of market confidence in the national economy, which in turn is reflect instability in the currency and financial market. In times of a fiscal crisis, we can see that the asset price in the economy fall sharply. Investors usually start to sell assets in their investment portfolios and put their capital into precious metals, such as gold or silver. Probably the best example of a fiscal crisis in recent decades is Greece. This country faced economic problems after financial crisis in 2007 and 2008. In December 2009, revised statistics showed that 4 years Greek governments missed and reported a lower deficit than in reality. Greece's new government reveals a public deficit of 12.7% of GDP, more than 4 times the US allowed level. Government debt as a percentage of GDP is used by investors to measure a country's ability to make future payments on its debt, thus affecting the country's borrowing costs and government bond yield. In the chart, we can see that Greece recorded the highest level of government's debt to GDP in 2020. It was more than 206% of country's GDP. But let's back to beginning of the Greek crisis. The markets began shake. Fitch rating agency got Greece's credit rating to BBB+ from A-. Within minutes of the decision becoming public knowledge, the Greek stock exchange began to tumble, with shares falling by 6%. European stock markets tumbled, and the euro weakened sharply against the dollar and the other major currencies. Highlights fears about the potential consequences for the eurozone if Greece defaults on its most expensive debt in the UA. In the chart, we can see Athens General Composite Index, which is a measure stock market index, which tracks the performance of Greek stock listed on Athens Stock Exchange. The value of the index has fallen from 2,683 euros in 2009 to 1,121 euros in the first half of 2023. Although the price of the index has fallen, has risen by 30% over the last year, it is still well below last record heights. The crisis in Greece, last page. So the crisis in Greece led to a loss of confidence in the Greek economy, indicated by a widening of bond yield spreads and the rising cost of risks insurance on credit default swaps compared to the other Eurozone countries. Yields on 10 years government bonds rose as high, more than 13% in a secondary market in June 2015. Yields on 2-year Greek bonds stood more than 30% at the same time. It is important to note that yield evolve inversely to prices. If bonds are in demand and their price increase, yields fall. Ultimately, this means that the country can borrow at a lower interest rate. In the last chart, we can see that the yield on Greece 10-year bond was 3% on Monday, and the yield on a 2-year Greek bond was 3%. It's better now. Although the situation is visibly improving, Greece's struggle with the debt crisis is not over yet. The country still has a long way to go. To conclude, the Greek scenario has shown a long-term negative impact on the local and partially on the whole Eurozone markets. Investors want fiscal stability. The growth of public independencies is a signal for them to move their assets elsewhere. Thank you for your attention.
Thank you. Thank you very much for the paper and the discussion. I really encourage you to read the paper because it's a wonderful overview of the good intentions to control individual states and how they went awry as soon as first problems develop. It was good and very rejuvenating experience because whenever I told someone that, do you realize that the EU breaks its own constitution? They always look at me like I was the crazy one, because surely, I mean, there would be systems in place to prevent EU breaking its own constitution. And then they ask you, well, okay, in your imaginary world, my imaginary world, they think, what are they supposed to have done to break the constitution? And they say, well, in this article, so-and-so, it says that and this is like 10 years ago, that individual states will not bail each other out. And this was at a time, 10 years ago, when states were bailing each other out in direct violation of it. And he said, no, it's just, you don't understand it. I'm sure it's meant something different. And when you show them that it actually says it there, they say, well, they've probably updated the constitution since then. It's no longer there. So it's a good proof. And like I say, it's a very readable. And I encourage you to read the paper that it really was like that, as we were saying. Yes, lawyers will always find, well, in some cases, actually, there's two particular cases of breaking the actual constitution. One of them was found a way around, as you will learn, through legal speak, by just relabeling something. And the other one didn't even get round to it, just happened. And, if you don't sue, then you can't expect there to be any voices against it. So it just basically passed through. We didn't change the constitution. It's still on the books, and it's still being broken. So as an exercise in political economy, it's a very, very readable and very worthy overview. Now, looking forward, I've noticed some skepticism from the speakers here about whether the changes and the reforms will be passed and whether they will achieve anything. Well, ladies and gentlemen, I bring you good news. They will be passed. That's good news, right? Well, you may also recall one of the definitions of democracy. If elections changed anything, they would have banned them long ago. I think we have to be skeptical. Why now? Why all of a sudden it's going to be passed? Why there's such eagerness and so many proposals how to change it, and one of them will eventually be passed. But we've entered the area of the problems years ago, 10 years ago at least, sometime even before the great financial meltdown, well, it's not really meltdown, financial storm, let's say, of about a dozen years ago. Individual states crossed the 60% magic boundary at various stages in the past, and there wasn't really a call to not only on them to correct themselves. Some formal voices were raised, but no attempt at reforming it. And the reason was that in that time, changing the rules and making them more harsh would have hurt. States would have actually had to do something about their debt to GDP ratios and general indebtedness, and of course they resisted. And that's why nothing was ever passed. It's only now that they seem to be willing to pass something which must make us pause and to say, well, maybe they're only willing to pass some reform because it's not going to matter. Because they found some other way around the problem, and therefore now that they have the third option, they're willing to pass some constraints on themselves because they're not going to hurt. That's, again, the political economy of making rules and making institutional rules. You will only make it and you will pass some constraint on yourself when that constraint goes away. So what is this magic that makes the constraints go away, and why are states so suddenly eager to pass these changes to constrain themselves because they know they have some other way, which they didn't have all those 5-10 years ago, basically before COVID. Why has COVID released them from this? Well, I have two suggestions, and I'm sure there's plenty of others. One of them has been nicely illustrated by a famous Czech cartoonist a couple of weeks ago. He proposed this as a joke. I mean, as you realize, there's always a paradox at the core of every joke, and the paradox here is supposed to be that the two dung beetles, the one which is struggling, rolling ahead, that's the can being kicked down the road as the problem rose ever larger, and clearly the ball of dung for that dung beetle is no longer manageable, and he's really struggling to do something about it. And the clever, inventive dung beetle comes along and says, well, the solution is simple. Why don't you make another ball? It's going to be easier. The cartoonist presumably thinks, well, this is really funny because, of course, we can't start government debts anew. We can't start from scratch. We can't repudiate our debts and start anew. So that's the paradox, and that's why it's a joke. Well, it's not really a joke, it's reality. It's reality of the EU today, where the fiscal space of how much more can individual states can borrow is being eroded by, oh, you want more money, and you're already 150, 180% in debt. Well, we know that Japan is 200 plus, but it's slightly different structure of the debt. It's mostly owned by the population itself, so that also behaves differently. So the larger that the government debt grows, the harder it is, paradoxically, to grow it even bigger, because financial markets are not going to lend it to you. So you invent a new figure which is going to take on the debt, one which hasn't been indebted so far, and therefore you can indeed start with a new ball. And that new ball is called EU debt, which came about as a result of COVID and the EU plans. This is a wonderful thing where you can start literally from scratch, and therefore you should be attracting the best conditions, and that debt should be rolling over in its attractiveness all other indebted countries, and wonderful new source. And by the time that the EU debt gets to the 60% of GDP, well, it's going to take a couple of maybe not decades, but at least a couple of years, that we will have bought ourselves the room to get into that more. And that's a wonderful thing for the individual states, because now one of the problems why their debts grew larger was that they were forced to co-finance all of the subsidies that they were getting from the EU, because the EU doesn't just give you money, it generally requires you to contribute something towards it. Now, if you want to use some extra free money from the EU, it means you have to run yourself into slightly greater debt, because in order to use that EU money that's coming your way, you have to contribute something out of your own national coffers. And if you don't have any money, then you have to get into debt in order to use the free EU money. And this is a wonderful solution out of it. Now, all the extra spending that the EU will want to do, well, so far not all of it, but eventually more and more will be loaded, no doubt, onto this new EU vehicle, and EU-denominated debt, i.e. debt by the European Union itself as a super-state entity. Then that means that the more you can load the future debt of ultimately individual states onto the EU itself, the less will individual states have to get into debt themselves. And you can have all the wonderful things of ever more spending from the EU. So that's, for EU, the danger; for individual states, a release from the constraint that they no longer will have to just accumulate debt in order to use EU money. Now, that sounds like a good plan until you look at what's happening with the actual performance of the EU bond. This is the classic yield curve, which basically shows you not only how the expectations are through time, that's the horizontal axis, but the vertical differences is basically the different faith that investors have to individual entities that have issued it, right? So the classic thing, of course, even if you don't read the legend, you can kind of guess what the top line is going to be. It's going to be probably Italy, right? I mean, you might think that it's Greece, but usually the Greece figures are no longer reported because nobody really believes them, that they reflect any reality, because there's such mess about who owes what part of the Greek debt, etc., and therefore it's not really takeable as a representative example of what the financial markets think of the country. But Italy, there's quite a big spread of how much more, and it's part of the same currency thing. So the underlying interest rates are the same in Italy and in Germany, Germany being, of course, the bottom, the yellow line. And the difference means, well, how much less do the financial markets in different periods believe in the repayability of the Italian debt versus the German debt, right? Now, theoretically, given what I said, Germany certainly doesn't have zero past debt accumulated, and it's been one of the countries that broke through the 60% rank even before before COVID. It's lower than Italy, but it's higher than the Czech Republic, and yet it's taken as this token of financial probity and good public finances. And from that point of view, it's surprising that the blue, the EU bond, is not even lower than Germany, because remember, it starts from zero, so there's no inherent risk that you've inherited from the past. Who is going to pay back the EU bond? Who is the underwriter that the investor, the lender, will get their money back? It's the EU. Where does the EU get its money? From Germany, right? So, if anything, the EU in its repayability, whatever the German taxpayer is going to be able to repay through the German bond, the EU bond should be able to just replicate it, right? The EU is the meta, or in German, we should actually say Überbond, over the German bond. And if worst comes to the worst and nobody else is repaying the EU bond, well, the German, as the payer of last resort, partly to atone for Hitler, it's going to always step in. Sorry? Okay, I forget what I said about Hitler. It was a cheap joke, I admit. But the other joke wasn't cheap. Okay, I will...
We got the motivation. We got the motivation and then...
Okay. Okay, never mention Hitler. Point noted. Don't mention the war, yes. Okay, so that's a surprising puzzle, right? Why the EU bond is trading above. The explanation usually given in the literature is, well, because there's not enough of them, and therefore the fact that, especially at the longer distance, what they're worried about is that in the future, when many of the bonds will have been already repaid, and so few will be in 10, 20 years on the market, it will actually be difficult to sell it, because there's not going to be that many buyers. The market is not going to be deep enough. You will find it difficult to buy enough people interested in it, because there's not much left EU bonds to be repaid, and that's why you're requiring premium. That's the general explanation. Now, there is an easy solution. Just issue more EU bonds. Then you won't have the problem that the investors are worried that in the future there'll be one of the few last ones left sticking to the already existing EU bonds, when there are constantly new ones being issued, and it's a classic story of a rollover bond. So that's the one, get out of the jail for free card. And the second one is the other, not dung beetle, but elephant in the room, which is inflation. Throughout this evening, we've been talking about as debt to GDP ratio as the ultimate measure of how do we measure the indebtedness of the country. Now, there's no reason why we should stick to that measure. We don't measure the indebtedness of a family relative to its potential income. We measure it to its actual income. So if we wanted to replicate that in government finances, we should not measure debt to GDP, because GDP is not income of a country, the tax revenue is the GDP of a country per year, just like GDP. So another good measure might be debt to government income or government revenue ratio, which has been proposed in some parts of the literature, but we're not going to change that tonight. We can note, however, that the debt to GDP ratio, the classic one, is measuring it to nominal GDP, not to real GDP. Nominal GDP has the advantage that it gets increased for free through inflation. Real GDP doesn't get changed by inflation, but nominal does. So automatically, inflation, which is experienced in all of these countries, automatically lowers the debt to GDP ratio without any real fiscal effort required of the governments to actually repay some of the debt. The debt, as we measure it, is just devalued. Of course, the investors who have bought the debt will be the ones on the short end of the stick. They will pay the price for it. They will subsidize the governments in that way. But from the point of view of a debt to GDP ratio, you can just look at what's happened to that debt to GDP ratio based on the last figures we have available over the last calendar year. And you can see that all countries pretty much have reduced their debt to GDP ratios. Now, some of them have indeed tried hard to de-COVIDize their budgets, and they have started to repay some of the debts, or at least run smaller and smaller deficits. In fact, you would have to basically run a surplus to reduce a debt to GDP ratio, and there's not that many countries that actually ran surplus. So what you see from most countries is the work of the inflation. If you have 10% inflation in your country, then that sort of repudiates 10% of the debt. And that's just in 1 year. If you have 10% inflation for 2 years consecutively, yes, you might have to start in between paying larger interest on the new issuance of debt, but all of the past debt will have depreciated by 20%. You will have repaid effectively 20% or almost 20% of your debt. And that's the real danger into the future, that any reforms that we will pass and that the states will gladly pass, as long as they stick purely to the debt to GDP ratio, we're retaining in the system the motivation of countries to just inflate their debts away because they will always work to rule. If we make the rule about debt to GDP ratio, okay, fine, but you have always two parts of the fraction to work with. Either the numerator, which makes hard work, or the denominator, which you can easily increase and therefore reduce the whole fraction by just running the inflation. And if you add to it the problem of the fiscal dominance, the fact that the central banks might be, or the central bank in the EU, might be prevented in fighting inflation enough because it might get worried about the actual repayability of the debt, well, that's another reason to worry about long periods of higher inflation that we're used to. Nobody's saying that we're going to have double-digit inflations in the future. We might, but the chances are small. But if you're not reducing 10% of your debt just in this nominal terms a year, but if you're reducing only 5%, that's still a pretty good deal compared to the alternative of having to actually repay that. You will notice, in conclusion, that the only country that, in spite of its high inflation, managed to increase its debt to GDP ratio is the one that you're sitting in right now. The last thing I'm going to say about that is the Czech Republic usually uses the argument, oh, we're not part of the problem, we're under 60%. It should be the others who are over 60% who should be worried about. We're actually under borrowing because we are allowed to borrow 60%. So if our debt is less than 60%, we're somehow failing our voters by not borrowing and not indebting their children enough, because we still have that 15 extra percentage points up to 60% that we're allowed to. Now, that's just not understanding the percentages. Increasing your debt by 15% from current 45 or whatever it is up to 60 is something completely different than increasing your debt by 15% if you already have, like Italy, 150, 180% debt. Italy has already shown that it is more or less somehow managing to live with 100% plus GDP, debt to GDP ratios. Increasing it by 15 percentage points, not many people will even notice. And this is not a remark about Italians. This is a general remark about percentages. If you increase by 15 percentage points a debt which is at 45% level by 15 percentage points, well, you've increased it by more than a quarter. Czech Republic has not yet shown that it can live sustainably or pseudo-sustainably with debts over 100%, and that's why the 15% that the Czech Republic is thinking about adding is going to be much more problematic than the 50% that Italy might be thinking about. So just as a last food of thought, it is not just the problems at the high end of the indebtedness that we should be worried about and we should adjust the rules about. We seem to be only concentrating to the high end of the indebtedness, but they have the advantage of already having shown that they can somehow live with it. As long as it's not going to explode, it's okay. At the bottom end, which we think, oh, it's below 60%, so it's safe, might actually ultimately prove to be just as much a big of a problem for the financial markets and for the individual countries as at the high end of the percentage rates. So thank you very much. That was just me sharing the two elephants in the room, but otherwise, very good paper. Please read it. Thank you.
Thank you very much for those discussions and comments. I think Jan has a lot of inspiration how to change the paper and take a different angles proposed by Petr, for example. So I will open the floor to other questions, other challenges or other ideas how the paper could benefit from your comments. Anyone would like to raise a question, a comment? Yes, please.
Thank you. Hello, Martin Panek. I'm with the Liberal Institute. I've been hearing these debates now for, is it 20 years? Yeah, 20 years that we've been in the EU, and there's always the Commission publishes papers, pushes papers, rejects other papers. It's very good at pushing papers on the desk, but as far as I can see, the situation has only gotten worse in the 20 years, and I don't see in the institutional framework of the EU any reason why it should be any different when we meet here in 2043. It's only going to get worse, so what are we even debating?
Well, that's a good question. I mean, of course, you could argue that every academic debate about fiscal rules is futile in the end because it won't have any direct impact on policy making. But I mean, what else could we do? I guess we need to have this little bit of hope that by advising politicians and advising also the European Commission that some of the advice will in the end bear some fruit and lead to some improvements in the rule framework. I mean, I certainly don't believe that any ideal rule framework will be implemented at any time. So that certainly won't happen, but at least you can work incrementally towards the small improvements and hope that something will improve. And I guess I share your general pessimism. I also believe that there won't be really huge improvements of the set of fiscal rules, at least in this round of negotiations. And maybe we need to experience another really dramatic fiscal crisis. I hope it doesn't come, but it might come if the rules don't work. And then maybe we have some pathological learning again and learn from severe mistakes, and maybe then there's some chance of reproductive reform. But then at least it's good to have some concepts in the drawer that you can take out, I guess, in that situation. So.
I think we would have been far further along on the route towards some sort of reforms, and maybe with not such a large indebtedness today, in the world where an important player, which so far hasn't been mentioned much within the European context, didn't sort of spoil the game. The fiscal rules haven't been changed, and the debts have accumulated partly because it was cheap to do so. The debts accumulated, especially, you're going to accumulate debts if you're paying essentially zero interest on it. So the low interest rate certainly helped the debts to accumulate. So partly because of the recent 10 years of low interest rates, we have now more debt than we would have. And also, it prevented it being an issue for the policymakers to do something about it, because the debts just kept increasing without any punishment. And here, the punishment would have been meted out in a gradual form before we hit any fiscal crisis by, on the previous slide, by the gradual adjustment of the interest rates that the more indebted countries would have had to pay for their greater risk of default, etc. And as we know in economics, everything can adjust provided it's given at least some time to do so. These expectations that we will adjust overnight are of course futile. If you want overnight adjustment, Stalin is okay to mention? Stalin is your man. He can execute changes overnight. Markets need some little time to adjust, but they need to adjust gradually to the smoothly adjusting greater and greater risk premia paid on the highly indebted countries. If they were allowed on the market, then we probably would have already, at least some rules would have been implemented precisely so that the countries are not paying the extra premia. Now, if the premia itself were not enough to constrain the indebtedness of Italy and Greece and Belgium and other countries, then okay, to the extent that there is some spillovers, the externalities, as we've heard at the beginning, the rules would have already been changed. Maybe not to an ideal state, but would have been made more biting. But because the ECB is doing everything in its power to smudge away any relative difference between the risk premia of individual countries, then there is no incentive in the system to change it. Because there is no penalty for increasing your debt, because that risk premium I was showing you on a previous slide is relatively small. It's much, much less than it used to be before the creation of common currency and before the involvement of the ECB. So the greatest enemy of a reform of the fiscal rules, from that point of view, in terms of proved track record, to me seems to be the ECB, by preventing the gradual adjustment to the market signals. If the market signals cannot work, you cannot expect the institutions to adjust in a non-revolutionary way, which is always the cheaper one.
Thank you very much, and maybe it's hard to disagree, but maybe I would add one more factor to this circumstances is also the diabolic loop between financial sovereign and the rating risk, yeah, because governmental bonds are perceived by banks, which is the first buyer of governmental bonds, as a zero risk, yeah? So if we sort of try to, that would be an instrument, if we make these assumptions gone, that governmental bonds are free risk instruments, then would probably be also different indebtedness picture. So this is, incentives are a little bit further, because we discussed who is owning this debts, yeah? in Italy, there were banks. That's why it was also political reasons not to do something. So I think the underlying issue, it's less governments, because as we said, governments are very short-sighted. They comes for, as it was said, for 4 years or less. But the underlying assumptions of the market, how they are structured, I think here it's the assumption about zero risk for the governmental bonds. It's assumptions that doesn't fit anymore, given the picture we see on the slide. Thank you. Anything else from anyone? So thank you very much. On behalf of IREF, I would like to thank our main speaker and our discussants to the paper. It was very excellent presentation. So thank you very much for attending, and I hope we can see next time as well. Thank you so much.